In an effort to fight inflation and protect the job market, the U.S. Federal Reserve Central Bank on September 18th announced that it was cutting interest rates by half a percentage point. This was noteworthy as it represents the first rate cut since 2020 and is not expected to be the last. They expect borrowing costs to drop another half point this year and a full point in 2025, making it cheaper to get loans, finance businesses, and many more implications for day-to-day life in America. In this episode of the Nexus podcast, we talk to Davinder D.K. Malhotra, a professor of finance and director of the university's MBA programs, and his colleague Tim Mooney about the importance of the rate cuts, particularly what it will mean for students and alumni today and in the future. They offer some context to better understand what it means to you. So let's explore what these rate cuts mean.
My name is Tim Mooney. I'm an associate professor of finance in the School of Business, and I've been here for about 8 years.
Can you give us a little background on what the Federal Reserve is and how it plays a role in the nation's economy?
The Federal Reserve has two jobs in managing the economy. One is full employment, so minimizing unemployment, and also stable prices, keeping inflation in check. A major tool that they have for achieving this goal is adjusting one particular interest rate, the federal funds rate. Other interest rates go up and down, car loan interest rates, mortgage rates, credit card loan rates. If rates are too high, then borrowing costs are high, so firms don't borrow as much, individuals don't borrow as much, they don't spend as much, firms hire less, so there's higher unemployment. If rates are too low, then the economy overheats and inflation is higher. So there's uncertainty about what the right level of interest rates is.
Please explain what happened with the Federal Reserve's rate cuts.
The Federal Reserve lowered interest rates by half a percentage point from about 5.5% to 5%. And this lowers borrowing costs across the board and is in line with its goal of keeping unemployment low and also managing inflation. The reason they did this is that inflation has come down significantly over the last year or so. Prices were rising on average by about 8 or 9% on an annualized basis in late 2022. And then the annualized rate of inflation today is around 2.5%. So inflation has come down recently. And also unemployment has ticked up over that time period. So it was appropriate for the Fed to lower interest rates to try to pursue their dual mandate.
Professor Malhotra explains why these rate cuts were the first to occur since the year 2020.
2020 pandemic, everybody's aware of it. Obviously, businesses were closed, so world economy basically came to a standstill. So a lot of money was pumped into the economy to help people who lost their jobs because of the lockdowns. So money was in the pockets of the people, and keep in mind, factories were shut down, supply chain was disrupted. As we started reopening the economy in 2021 onwards, after the post-vaccination era, the demand was there, but the supply wasn't coming forth very quickly because it always takes long term to fix the supply chain. Demand is always short term, immediate in nature. That started pushing up the prices. And interest rates were very low, so the demand was very high. Interest rates were practically close to zero at that point in time. Demand was coming, supply was not, started causing inflation.
Professor Malhotra expands on the dual mandate as referenced earlier by Professor Mooney.
The mandate that the Federal Reserve Board has is making sure that the prices are stable and employment is maximized. The growth is not hurting on that particular part. Initially, they wanted to generate growth, and as growth came, now the prices started rising. 2021 prices went up, housing prices went up, cars were not available, so used car prices actually started going up. There was a pain at the grocery chain level. If you don't curb inflation, that can actually kill growth very quickly, and it can be very hard landing for the economy. To preempt inflation, Fed started aggressively raising the rates beginning with 2022, and in fact, the speed with which they raised the rates was so quick that if bond portfolio managers didn't manage their interest rate risk properly, they incurred heavy losses. And Silicon Valley Bank that collapsed is one example of it, where the loss was into like several $1 billion for them on that particular part. So rates started going up to bring down inflation. The goal was bring inflation down, keep an eye on growth, making sure that growth doesn't get hurt, employment doesn't get hurt. So now we have reached a point where they realize that, okay, economy is doing well. Unemployment hasn't gone up too much, and they feel that inflation is now under control. Their target inflation rate is around 2%. So if it is at 2.5%, they believe that they can bring it down to 2%. Most of the people don't understand the meaning of the word inflation, because if you talk, they will say that I'm paying still higher price at the grocery chain. Yes, but they are not going up any further. Inflation under control means that prices are not rising anymore. You don't want prices to decline. That can be deflation, and that can be very dangerous for the economy.
With that background offered for context, both professors were asked to explain how this could impact our everyday lives. Let's start with Professor Malhotra.
Some will be impacted more, some will be impacted less, and some sectors will feel the impact slowly over a period of time. Keep in mind, this is only the first rate cut. How is this going to impact car loans? People got used to buying cars by paying a very low rate of interest for a long period of time, mainly because after the 2008 economic crisis, the Fed under Ben Bernanke, who was the chair, engaged in a operation which brought down the long-term interest rates. For a very long period of time, rates were very low, so we got used to very low rates. As the Fed raised the rates in 2022, typically you have to pay more than 7% for a new car on average, depends on your credit rating. For a used car, it went up beyond 11%. So obviously buying a car became a problem for average American. Now, this half percentage point, it will bring down the car financing to some extent. Definitely it makes it attractive enough for people to look at the market. So should I go and shop for a new car now? Should I wait for December, another rate cut? Keep in mind, lenders already factor in that there is going to be another rate cut soon. So they will be giving you attractive offers in terms of financing. And again, do I look at used car or do I look at the new car? If you are financing, new car is less expensive to finance. All of these factors will determine, but definitely your borrowing cost is going down on the car side of it.
What about credit card rates and the impacts on small businesses?
The average credit card rate was close to 21%. This is going to have an impact in terms of lower rate on your credit card bill, but it'll take some time. Over a period of time, you will realize that your monthly payment is declining on the credit card, mainly because the rate has gone down. It's definitely going to have a more positive impact on small businesses. Many small businesses use credit card to buy small equipment and then put it on the card and pay it as your revenue comes in. The key is once they start the process of cutting the rates, like now, once again in December, and I'm hearing one more in next year, so that the average rate comes down significantly from the current rate that the federal funds rate or the key lending rate is there for the bank. This will jumpstart economic growth even more. So you're looking at, while they're keeping an eye on the unemployment, slightly ticked up. Keep in mind, the rate is basically the cost of money. So if money becomes expensive, many projects and expansion plans, they are no longer attractive for you. If the hurdle is being lowered, that means many projects are becoming more attractive. So many of these tech projects, which they had put a hold on, they will again start it. It will create more employment. Not only that, there are other businesses which are in the supply chain or pipeline to supply to these bigger businesses. They will have more demand coming in. Small business growth depends on these kinds of costs, and as a result, the economy will prosper.
Professor Mooney was asked his view through the lens of its impact on students.
That's a good question. The reason interest rates are declining is because inflation has come down. So a bigger impact on maybe the student or the everyday consumer is interest rates can come down because inflation has lowered, and keeping inflation low can impact the everyday consumer a lot, because for folks with lower incomes, they spend a higher proportion of their income on necessities like groceries, housing, and even basic healthcare. High inflation has a disproportionately negative impact on probably students and the everyday consumer that doesn't have a high level of income. One thing to keep in mind is that as interest rates come down, not all interest rates will adjust automatically. So for example, credit card interest rates will probably come down over time, but maybe not right away. And banks may try to keep rates higher. Interest costs for credit card balances may stay high, and it might be worthwhile to shop around for a card with a lower rate. On the other side, savings account rates are expected to decline as interest rates decline as well. So it might be also a good time to think about shopping around for a higher yielding savings account if that's important to you.
When it comes to home sales, particularly first-time home buying, what do you think the impact of this will be on that, particularly with a sense that maybe people won't be willing to sell their houses now, especially if they got a good mortgage rate if they bought at a time when it was lower?
Yeah, that's been a big factor. High interest rates have really slowed down the housing market because, like you said, people who have locked in a low mortgage rate are largely unwilling to move homes and sell their existing house and buy a new house, because that means that they would have to get a new loan with a higher interest rate. It has really slowed down the housing market. My hope is that continued declines in interest rates will have two benefits for first-time home buyers. First of all, as rates come down, new mortgage interest rates also will decline, which is good for borrowers. On the other side is that as rates come down, whenever you buy a house from somebody, typically they have to move out because they tend to reside there. Hopefully existing homeowners with locked in low interest rates will have more of an incentive to look around and perhaps list their homes and look to move. So it'll probably take time, but I'm cautiously optimistic that the housing market will improve as rates come down.
Professor Malhotra concurs with those sentiments.
If you bought a home in 2020 in the pandemic or 2021, you are one lucky person because you probably ended up with a mortgage loan of about 2%. I know some people got it at 2.5, 2.75. You cannot even imagine that because the mortgage rate is pretty much 6.5 to 7% right now, which used to be the case back in 1999. When you look at mortgage rates, it was around more than 7%. I remember buying the house, locking in 7.25% at that point in time. The rates went down during pandemic. If anybody locked in at that point in time, obviously they are not going to refinance the house because the rates are very high. And even if they want to sell, it doesn't make sense for them to sell the house because they are locked into 2.7475%. When the rates went up, and people were saying that it's too expensive for them to buy the house. Even then, the housing prices did not decline as much as the Fed wanted. Why would I sell the home if I'm paying only 2.745%? It doesn't make sense. I can put that money in a CD and earn 5%, 5.5%.
So then we will see an impact on mortgage rates.
With this particular rate cut, obviously the mortgage rates have started going down. And now the market expects that there'll be more rate cuts. So slowly mortgage rates will go down. You will be able to afford mortgage loan. The problem here is with the rate cut, housing prices may go up again because there is demand being coming on the market. Housing prices will go up. One thing to be very clear that mortgage rates are not going to go back to the 3% era. That is gone. Even if it goes down, probably you're looking at 5% in 2 years' time. So if you are able to get to 5%, that will be very good. And if you already bought the house now and during high rates, there is refinancing opportunity coming your way. You will be able to refinance it. With regard to the banking savings account, which were giving you now yield, that many of the savings accounts were offering now, that's going to go down. Money market accounts, CD rates will go down. So people will have less incentive to put the money in a certificate of deposit because the rate is going to go down. Obviously, this is basically more investment opportunities are going to open up on that part.
Is there anything else of importance that you think people should know about this?
If you are in the retirement account and you're a bond market investor, like many people say, I want to be in fixed income. This rate cut has already going to start pushing up the bond prices. There is a negative relationship between the interest rates and bond prices. So rate cut means bond prices will go up. So if you have in your portfolio fixed income securities, they've already gone up in value, you will be very happy that you are making a capital gain on this particular part. But on the other hand, if you are planning to include more fixed income, you can include them even now because there are more rate cuts coming in the future.
Thank you both for taking the time to explain this. So what should our final takeaway be?
The main driving force here is usually during peace times, this large rate cut is not expected. In 2020, there was pandemic, so obviously a big rate cut. There is good news that they decided to cut the rate aggressively by 50 basis points. The concern sometimes from the economist's viewpoint is economy is doing well. So what does the Fed see that common person doesn't see?
To learn more about this and other Jefferson stories, please visit jefferson.edu/the Nexus. Today's interviews were conducted by Brian Hickey with production support from Dan Bernstein. Thank you for listening.